Hello everyone and welcome to our YouTube live, and it's a very special session tonight because I've got my YouTube award which I'm going to open in a minute, and Teddy's very excited about the award. Or is it the treats, Ted? Is it the treats? I think it probably is the treats, isn't it? Yeah, so anyway, we're going to open our YouTube award because we've got 100,000 subscribers, and I should also mention that we'll be with you for an hour, same as usual. And if you ask a question and you're one of our YouTube supporters, we can tell because you've got one of those nice crowns next to your name, like Thomas Crew and John MSP. And if that's the case, then we'll answer your question first. Or if you do a super chat, and remember, you can always join, you can always become a YouTube supporter live online, and then we'll see the crown by your name if you do that. And a super chat also will get pushed to the front of the queue. So 1 hour together, and anything you like to ask about finance, you can ask. So let's get cracking with the unboxing video. Can't believe you get this free on TV, on YouTube. Watching an old bloke open a box, but here we go. So this is the... Do you
want to go full screen?
Oh yes, sorry, I'm not full screen. You won't be able to see a thing. Right. Yes, so now we are full screen and you'll be able to see what I'm doing. So this is the award that we got, and so I'm quite excited to open it. Let's just see. I had to kind of undo the fastenings beforehand, so there we go. I've got a letter from the YouTube CEO, hopefully. Yes! So it says, congratulations, you've done something that very few YouTube creators accomplish. You had an astonishing 100,000 people subscribe to your channel. So here's a nice letter from Susan, who's CEO of YouTube. And here's the award. It's very shiny. I'm very excited. So poor Teddy, he's going to have his name replaced up on the wall. So it'll probably go up on the wall over there. And yeah, there it is. A lot of hard work. And that's what we have to show for it. But anyway, thank you all for supporting us, because I suspect many of the people on the call tonight have been supporting us for a very long time. And of course, you know, the feedback we get from you is very positive and it keeps us going. And of course, the monetary contributions keep us going as well for the YouTube supporters, and also our Patreon community, which is kind of like our family as well. Thank you to all of you for that. And as usual, thank you for the great questions, because I'm always amazed by the quality of the questions. Teddy, you probably don't want that, I'm guessing. I think he's going to hold the award ransom in order to get more treats. Here we go. So celebration, Ted. Celebration. Yes! 100,000. Brilliant. Okay, so let's get started on the questions. And probably worth mentioning as well that for Patreon supporters this week, the video that we did was about Fed policy. And if equity markets crash, will the Fed reduce interest rates? And what was interesting is you can kind of build something called a Taylor rule, which looks at the level of inflation versus the 2% target. And it also looks, you can use growth as one of the inputs, but I used unemployment relative to full employment, and I added the S&P as well. And you can build a fairly simple regression model. And what's shocking is that the actual policy rate, which the model forecasts, is crazily high. It's much higher than 0.8%, which is what we've got now. But of course, the model's completely naive. It doesn't know about transitory inflation. It doesn't know about whether it's demand pull inflation. It just sees a number and thinks that you have to hike. But of course, that's why we don't have a machine running monetary policy, because it would be a disaster. Probably worth also just quickly looking at the inflation numbers, because I think it's something that's got to fever pitch now in terms of commentary, kind of forecasting the end of the world, because inflation was high. So this is the latest print that we got this week on CPI, and it has this beautiful breakdown. So the all items number year on year is still up 5.4%. And if we break it down into its subcomponents, you can see that gasoline is still up by 42% year on year. So that's certainly one of the big contributing factors. The other interesting thing is what was at 40% but isn't anymore is used cars and trucks. So if you remember, this went up all the way to about 40% as well, but this one has already started coming down. And this is why the Fed says it's transitory, because many of these bottlenecks in supply will be transitory, and the year-on-year huge growth that we saw for gasoline prices, again, that will be transitory. It won't go up at 40% every year for the next 10 years. That's just not going to happen. So, you know, we haven't really seen gasoline prices start to come down rapidly, but I suspect that'll happen over the next few months or so. So you can see why the Fed dot plots, the FOMC's dot plots are forecasting that inflation will come back down to around 2 to 3% next year, because many of these things will be transitory. And if we actually have a look at the numbers, so this is on the Fred database. So the red line here is the year-on-year change in gasoline prices. And you can see that that's still at 42% year-on-year. So that's the red line. But if you look at the used car and truck prices, that's in blue. You can see that that's actually come down to 24% year-on-year growth. So much smaller. And it's already peaked. In fact, that peaked in June. And gasoline prices, the year-on-year growth, peaked in May. So it does look as if those are coming down. Gasoline's taking longer, but of course that one is a year-on-year base effect. And we are comparing with very low gasoline prices last year. So there we are. I think I kind of believe the transitory narrative is still kind of intact, but you know, these things are always empirical. We just have to see what happens. Not even the Fed believes in its own forecast, so I don't think we should believe in any kind of model of inflation. We should just look at the numbers. But certainly I don't think it's time to panic yet, although there is lots of commentary suggesting that we should. Right, so back to me, and we'll start answering some questions. And we've got a question from a member already, from Thomas Crew, long-time supporter. Thank you, Thomas. He's got a gold crown, which means he's been a supporter for a long time. And Thomas says, does Teddy want an American girlfriend? An American girlfriend, Ted, what do you think of that? An American girlfriend with a diversified portfolio of frisbees, rubber balls and peanut butter treats. I think he'd definitely be in the market for a girlfriend. What do you think, Ted? Because, you know, he hasn't been muted. So I think it's a definite possibility. And the kind of peanut butter would just be a bonus, really, wouldn't it, Ted? He's a very kind dog, though, so he'd probably be willing to share. So there we go. So John MSP, another supporter, thank you, John MSP, says, Buffett Munger have bought more Alibaba now to judge the black swan risks. Have bought more Alibaba. How to judge the black swan risks. How to assess share price volatility in the medium term, e.g. plus or minus 20% during a 6-month period. Well, yeah, I mean, Alibaba, the sell-off has been very brutal. So if we actually look at the price of it, let me get it up on SharePad. Alibaba. Here we go. Let me share my screen so you can see this. And we'll look on the NYSE. And I'll share. There we go. So this is what the share price looks like for Alibaba. And obviously it's been fairly brutal. There has been a bit of a bounce recently, so over the last couple of weeks. But we're still looking at a drawdown of, oh gosh, about more than 45% from the peak. And the peak was before the end of last year. And it's down by about 47% over that period of time. But we have had a fairly chunky bounce recently. So if we look over this period, it's up by about 15%. So off this bottom at the beginning of October. Now, is it the case that Alibaba is completely stuffed as a company? I don't think so. Certainly in the past, what's happened is that Alibaba's fallen foul of the authorities several times, but it's always somehow managed to get back in their good graces. I think what the Chinese government doesn't want is for any company to become too powerful, because that would threaten the power of the Communist Party, and that's something they want to avoid. But if for example, if Alipay basically became the go-to commerce platform and began to control all commerce in China, kind of like Amazon dominates the US now, I think that the government would probably step in and split it up or kind of somehow reduce its power. And, maybe the US government should do the same with Amazon. Some people think that should be the case. But would I invest in Alibaba now? Yeah, I think I probably would if I bought single stocks. Or if you go for example, the Crane Shares Internet ETF, KWeb. Now, I lost a lot of money on that, but I haven't sold it because I do think it'll probably come back. I might even buy a bit more. I was just thinking about that today, actually. And the share price of that looks very similar to Alibaba, which isn't really surprising given that Alibaba is so big in terms of market cap. So you can see that's also down hugely by about 50% over this period of time. So down 52%. But that also has had a bit of a bounce recently. And if we actually look at the portfolio composition for that KWeb ETF, you can see that the largest holdings are Tencent, Alibaba, Meituan and JD. And it's very concentrated amongst these, 5 or 6 or 10 names. So I think that certainly would be an interesting thing to do. Buy either the ETF or buy some of those single stocks based on looking at some of their fundamentals. That's probably what I'd do if I was going to buy the single stocks. But if I was just going to buy the ETF, I think now might not be a bad time to do it, because I think we could see quite a bit more upside. And certainly if equity markets sell off a lot, KWeb is one of the things I'd probably buy if it was at a much lower price even than it is today, which it would. I mean, of course, it would fall if all equities fell. So, I think that could be interesting. Now, your second question was about volatility, which is kind of interesting. Let me just get the question in front of me. So the actual question was how to assess share price volatility in the medium term, e.g. plus or minus 20% during a 6-month period. Well, I think what you're talking about is actually slightly different from volatility. You're talking about the actual drawdown that would be potentially on the cards if we do get an equity market fall. So, if we do get a severe shock in equity markets, then given that valuations are still pretty high, there wouldn't be much support from a fundamental buyers on a kind of fundamental basis. So we could quite easily see a 30% fall, I think. But that wouldn't necessarily be a bad thing, because things are very overvalued at the moment. Even now, after we've seen earnings grow quite a lot and share price growth slow down in the US. So I think, if we look at volatility at the moment, VIX has been creeping up around 20 after a period of being very low. And we've also seen that sell off from the top of the equity market from the beginning of, I'd say mid-September. It peaked in the S&P, and it's off still by about 5%, I think. So, I think that volatility is likely to stay for now, because we're still seeing this uncertainty about monetary policy. We're still seeing inflation high, so people aren't really sure that the narrative is correct about being transitory, and people are getting more scared that it's not transitory. Personally, I'm still in the transitory camp. And of course, we've also started talking about raising interest rates. So it's pretty much a dead cert now that we're going to see interest rates rise probably end of next year, almost certainly by the end of next year. And we definitely know we're going to see tapering in November begin. And we also know roughly that the rate of tapering, the rate at which they slow down their asset purchases, mean that it'll be complete in about 8 months. So it'll be a fairly rapid taper from $120 billion a month in purchases down to zero over 8 months. That's what the Fed minutes say, if you just look at the latest Fed minutes. So, yeah, I think all of that kind of combines to make a fairly uncertain backdrop. Although we have seen markets rally fairly strongly today, I still think, we could be in for a choppy period, because a lot of the euphoria that was present before has kind of come out of the markets. And I think people are just more cautious now. I can just feel that that's the feeling I get looking at markets. Yeah, so that's how I'd assess volatility. I think it'll probably stay high, and the risk of a drawdown I think remains elevated. But you should always have a plan for when this kind of stuff happens, when equity markets fall, because it's going to happen, right? It's just a question of when. And you should have some things to buy on your shopping list ready, and don't sell. That's the way to approach it, because you won't be able to time it beforehand. That's almost certain. Right, so let's go to YouTube and have a look at the questions on here.
Like and share.
Oh yes, like our stream. That helps us a great deal. And also share our content with other people so that other people learn about our channel, because, I think it's useful for a lot of people. That's what you tell me. And why not let other people know about it? And of course, you can always support us on YouTube as well. That helps us a lot. And there should be a join button under the video if you do want to support us. Obviously, that helps us a great deal, because it means we can still eat, and I can afford treats for Ted. Okay. Question from Kevin, who says, Trading 212 updated their terms and conditions so they can lend our securities with collateral arrangements. Does this make them riskier to use? And do other platforms do this too? Thank you. Certainly, if you have an exchange-traded fund, almost any exchange-traded fund, you'll find that somewhere it talks about the collateral use, and they will lend out the stuff in the ETF. So if Trading 212 is also lending out collateral, then you could end up with things which are being lent out at two levels. If you own an ETF, that might be being lent out in order for other people to short it. And also the contents of the ETF that you own could be lent out to be shorted by the ETF manager. So does that make it riskier to use? Not really, because remember that if they do lend out, so let's say we've got two people, right? So this is Trading 212. This is somebody who wants to short a stock. Well, if Trading 212 lends them the stock, usually it'll be over collateralized, and usually this person will have given them payment in order to do that. And because of the fact that it's collateralized and marked to market, if there is a sharp drop in the value of the stock, then the person who's borrowed the stock will probably have to make a payment in order to ensure that the mark-to-market value of the loan isn't too far out of whack. So they're very careful with the risk with their counterparties when they do this lending. And of course, it generates an income for Trading 212, which is not shared with you, which isn't great. Whereas for an ETF, it probably is shared with you via lower fees. So the only kind of annoyance I think with Trading 212 doing it is that you don't get some of the goods. You don't get some of the yield which they're generating, I suspect. But the fact that they do it, not surprising at all. And payment for order flow, again, if you don't pay a fee when you trade, well, that's how they pay for it. That's how they manage to still be profitable, because they're diverting your trades to third parties for which they get a payment. And of course, that benefits them as well. And if they can get you to trade more, so if they can try and, get you to buy meme stocks, these are the hot stocks, this is our research about which stocks are hot, then obviously that increases their income and it hurts your performance. So try not to overtrade, because it'll make them richer and make you poorer probably. But also, I don't think there's anything you can do about the collateral lending. So I really wouldn't worry about it, Kevin. I think it's not a problem. It's just annoying they don't share income. Arsenio, who is a supporter, I know, because he often asks a question. Hi, Arsenio, with a cool name, surname Penesi, says, hi, Ramin, do you think synthetic ETFs that replicate the underlying index using unfunded swaps are safer than those using funded swaps, or is it not so important? Well, again, for the unfunded swaps, remember what they're doing is, I'm guessing what they do is, so imagine that you've got an unfunded synthetic ETF. If 100 billion comes through the door for your ETF, you don't need to spend all 100 billion to buy the stocks to track the index. In fact, with the unfunded swap, you only need a fraction of the value of the swap. So they can probably invest that in things like short-dated treasuries or something to generate a little bit of yield. And at the same time, they'll have to collateralize the swap with their counterparty. So they'll be marked to market regularly, probably daily, such that the price doesn't get too far. It never is the case that they owe the swap counterparty too much money or vice versa. So even if one of the two parties goes down in terms of bankruptcy, there'll never be much to pay or a very large loss if they don't manage to make good on the swap. So the fact that these swaps are reset regularly, probably daily, then means that there isn't much counterparty risk. So just rest assured that there will be a lot of risk management that goes on behind the scenes, which reduces the risk. And I know in the case of Blackrock that they have multiple swap counterparties. So instead of just having one bank, say Deutsche, they'll have three banks. Deutsche, Goldman, UBS maybe would be the three counterparties. So even if one of them goes bankrupt, the rest will be okay. So there are various ways to manage that risk. But would a funded swap be more risky? Well, I don't think so. They're always collateralized. So whether it's funded or not, the only difference I think is what they're going to do in the case of the unfunded swap with the money that they're not investing in the swap. What are they going to invest it in? Bitcoin? That would worry me. But usually they'll invest in something really safe with low volatility. So that's why I think it's not necessarily very risky in either case. I really wouldn't worry about that. But obviously there's a risk that you don't have to consider is what they do in the case of a physically replicated swap, where they actually go out and buy stocks. There you don't have to worry about these kind of things, counterparty risk and so on. So you're just assuming that their risk management is good, which in the case of a large provider like Blackrock or, another large one like State Street or it's another big one. It's funny because I've just done a video about this. The third largest would be Vanguard. So in those cases, they'd be very careful with the risk management. And they're the ones that provide 66% of the market globally, those three companies. So I really wouldn't worry about it. Unless it's a teeny tiny company, which might not be so good on the risk management. Right. So let's go back to questions. Oh. Right. Oh, we've got another members question. John MSP says, how many periods make a statistically significant trend? Okay. Well, it's hard to say really. I mean, one of the ways to approach statistical significance is have a counterfactual. So let's say that you look at how many active managers have outperformed over the last decade. What you can do is compare that with a counterfactual, which would be, let's imagine that performance is completely random. In other words, it is literally monkeys throwing darts at the financial pages of a newspaper. So if it was a random stock selection, how many would outperform. And how would the outperformance look? Would it persist or would it decay? And that's the way, for example, that S&P approaches their persistence scorecard. And they say, look, if it was random performance, what would we expect? And what they show, pretty shockingly, I think, is that mutual funds in the US are almost indistinguishable from random performance. So if they do outperform in a given period, that doesn't persist from period to period, as if it was absolutely random performance. So I think that's a good way to test significance, and it's intuitive and it's simple. What would happen if it was random? And would that look similar to what I just saw? So for example, let's say you're tossing a coin. If you're tossing a coin and you get heads 5 times, well, if it was random chance, the odds against that would be 1/2 to the power 5. So it's pretty low. So it's always good to compare with random performance, and also very simple to do. So I think that's the way I'd approach it. But even then, you won't have a definitive answer. It could be that this is just a fluke. For example, there was a very famous fund manager, Bill Miller, who beat the S&P every year. I think it was for 15 years successively. And then in 2008, he dropped to the bottom of the league table in terms of active management. So, was it statistically significant before that point? Yeah. I mean, if you just look at 1/2 to the power 15, if it was just random every year, that would be phenomenally unlikely. But, that's probably the way I'd approach it. But even if it is unlikely and it looks significant, then it could still be random. It's still possible that it could be random. So there is no kind of obvious answer to your question, but that's how I'd approach it.
This is a good time to talk about Robin.
Robin. Yes! Oh, I forgot to mention this. Oh no. So I've just reviewed a book for a video this Saturday. It's actually a book written about index management by Robin Wigglesworth, who works for the FT as their markets correspondent, their global markets correspondent. And I always love his articles in the FT, so I was quite excited that he was writing a book. And it's called Trillions, and it's about the birth of index funds. And I think what's really amazing about the book is it's not about theories, it's not about mathematics or Markovits or any of those kind of complex theories. It's about people and how people have shaped the index industry. And it's all about their kind of setbacks in life, their emotions. Some of them got diseases and died. It was an incredibly difficult process to actually come up with index funds, even though the market was crying out for it. Regulators made it difficult. Politics within organizations made it difficult. And a lot of the stuff in there is about the people who are behind the products and the stories of their lives, which I found really interesting. One of the most interesting, for example, is about how Blackrock really came to dominate the finance industry. And it wasn't an easy path, I don't think. And it speaks to Larry Fink, who's the CEO. It speaks to his genius, in a way, of how he kind of planned the takeovers and the growth of the company. But there are lots of brilliant stories, like how iShares, the ETFs came about, and how this lady who effectively managed their birth, if you like, Patty Dunn, started off as a secretary in Wells Fargo Investment Advisors, and in a very short space of time she became CEO of Barclays Global Investors and helped oversee the creation of iShares. Incredible, the story of how Patty Dunn kind of rose through the ranks. But of course, there's also stuff about Jack Bogle, which is almost like sacrilege, because it turns out that he wasn't, for passive investing his whole life. He was quite anti to start, and he was a late convert. But of course, he became very much on board with the idea later on, and he certainly rewrote the story later on. And in fact, Vanguard was one of the latest to create an index fund. It only managed it in 1976, but in 1971, Wells Fargo Investment Advisors had already created the first index fund. It was an equal weighted fund, so it didn't quite work, but it was still the first one. And there were several. By the end of 1972, there were, I think about 3 funds out there which were tracking the S&P. So anyway, Robin will be on this YouTube live, a special one next week, same time, at Thursday, 7 p.m. UK time. And I'll probably start off asking him a few questions, and then you can ask him questions after me. So have some questions ready about index funds, about Jack Bogle and the people who created index funds. And why not buy the book? It'll be out by then. Certainly it's out in the US now, and I think it'll be out in the UK as well by that time. I had to read it very quickly, so I took about a week, but you could probably read it quickly too. Anyway, so Robin will be with us next week, and the YouTube live will be posted in this description of this video if you want to have a look at the link, and after this video is published. Okay, so so that's the plan. That's the plan. And Robin will be great, I'm sure, because he's got some brilliant anecdotes. And also about the power of index companies, because they wield a lot of power over markets now. So he'll have lots to say about that too. Brilliant. So let's have a few more questions.
One from a member.
Oh yeah. So Arsenio is asking, how do you choose your broker? It seems the largest counterparty risk for retail investors to me. Well, personally, I go for, my choice is pretty much determined by what I want to buy. So I'm happy for my core portfolio, and that's my boring portfolio, which just has 3 funds in it, a global equity fund and a couple of bond funds. For that, I'm happy to use Vanguard. They're cheap, they're simple, the fees are kind of like capped at $375 a year, and that's across all of my products, my SIPs, my ISAs, everything. So that's fine. I'm happy with that. But if I want to do fun stuff, I can't do it with Vanguard. If I want to buy something toxic, which I know is toxic, just to remind myself I'm bad at stock selection, then I can't do that with Vanguard because they don't have single stocks. They don't have any funds other than their own. So I've got a Trading 212 account, which is also cheap. The trading is free. And that's what I use for my crazy fun portfolio. So it's driven by, does the platform A offer you the investments you want? B, is it cheap? Because remember that after 50 years, you're not going to turn back in time and say, look, I'm a £10,000 poorer, but I had a wonderful interface during those 50 years I've been investing. Nobody would say that. So, don't pay extra for research, which is probably useless and just marketing. Don't pay extra for an interface, which looks fancy, but which, let's face it, is irrelevant as long as you can buy and sell and track prices. That's why I think the fees are probably the most important thing. Maybe, neck and neck with, does it offer what you want? Does it give you the access to the markets you want? So I think those are the 2 biggest concerns. And then obviously the fees that you pay, the more you invest, once you get to about £70,000, £80,000, at that point, you probably want to switch from a percentage fee to a fixed fee, because the fixed fee will never go up. So even if you had 10 million, a fixed fee platform will still charge you the same every year, whereas a percentage fee platform will scale up with the amount you have invested. And I think for most people, the cusp is around £70,000-£80,000. So at that point, the annual fee will be, it depends on the platform, but that's the consideration. So Trading 212 is free. And the other one, which is very good for a fixed fee amount, is Interactive Investor, where I think it's 120 a year, something like that. So it's £10 a month, 12 months in a year. So cheaper than Vanguard's cap, for example, which is 375. So if you do have a large amount to invest, Interactive Investor is one of the cheaper platforms. iWeb is another one that's very cheap. And if you're a member on Patreon, I've got a review of all of the big UK platforms, which I did quite recently. So you can sign up for Patreon if you want to access that. yeah, I think those are my considerations. That's probably what I think about. But in terms of risk of a platform going down, I think that's negligible, because in the UK they're so well regulated. The regulator will be very carefully monitoring whether they've got sufficient capital to keep going. And the capital intensity of brokers isn't really that high, remember, because they never take a directional risk. They just have to keep the plumbing working, and they can generate a fee. And the more people they have, the greater the fee that they have. That's like a money machine for them from their point of view. They don't have to have huge investments. It's not like a factory where you have to buy machinery or rent space. They can minimize their outgoings. It's mostly staff and IT. Those are their big costs. And the regulator will be very sure that they won't run the risk of going down. Plus, any assets that you've got, you still own, even though the platform allows you to buy and sell them. You're still the beneficial owner of a stock if you hold it on any platform. And there usually will be a third party which actually looks after the investments themselves. It won't be, for example, Trading 212. It's probably Winterflood Securities or whatever in London that actually holds the investments. So I really wouldn't worry about the counterparty risk because I think we're lucky to live in a country where these things are strictly regulated. Okay, any other? Nope. Okay, so back to the questions from everyone. Here we go. Rob says, is crypto an effective or at least an okay inflation hedge? Hence, that may be one of the reasons why it's going up at the moment. I don't think so. I mean, it's not driven by anything other than narrative. So if people believe it's an inflation hedge, I think people might buy it if inflation spikes. But is it an effective inflation hedge? Not really. It's not linked to inflation in any way whatsoever. Or at least most crypto tokens that I know of are not linked to inflation. So no, I don't think it's an effective inflation hedge at all. All you can say about it is that its returns have been very high for many cryptocurrencies over the last 5-10 years. So in that sense, it's returned more than inflation, but there's nothing explicitly to say that that'll happen in the future. Whereas if you buy something like an inflation-linked bond, there is an explicit link between the price and inflation. And that's something which is very valuable. So is crypto an effective inflation hedge? No. Alexander Konopko says, hi Ramin, in your last video you said that bonds are a poor hedge in the case of a taper tantrum. Yes. Should we expect this scenario in the near future when the Fed tapers? If so, maybe it's worth to sell bonds. Yeah. The thing is, Alexander, I think what will probably happen, the Fed has said it's going to happen in November. The taper will start. They've told us the rate at which taper will happen, about, it'll be over in about 8 months. So by May 2022. So everything has been telegraphed up front. It's been very clear, very transparent. But equity markets will still panic. It's when you actually see that number fall from 120 billion to 100 billion in the space of a month, you think, oh my God, they're actually doing it. And then people start to think, what's next? Oh yeah, they're going to raise interest rates. So I think there will be panic. I think people will get scared, even though we can see it coming. We know how quickly it'll happen, when it'll start, almost certainly. But still people will panic. But I think it'll be short-lived, because a lot of the stuff which has supported equity markets for the past year, which is reasonable growth despite the pandemic, and good earnings growth, which we've seen after the pandemic, after the downswing, we got a massive upswing in Q2 of 80% growth in earnings. So I think as long as the earnings growth stays, I think any kind of sell-off will be short-lived. I don't think sentiment will suddenly disappear. The only risk, I think, is that inflation stays high, the transitory narrative is completely wrong, and the Fed is forced to slam on the brakes. And then, if they have to hike really quickly and very sooner than people expect, that'll be a shock. But again, I think that's fairly unlikely. I'd say there's, 1 in 10 chance of that happening. Much more likely is inflation will slowly fade. They'll wait for unemployment to fall down to maximum employment, whatever that is, 4.2%, something like that. And then, they'll start to hike. And they'll probably do it very cautiously. Usually they raise it by 0.25% every meeting. And if it starts to show signs of volatility in equity markets, they'll probably step back. That's what's happened in the past. So I really wouldn't worry too much about it. Would I be selling my bonds now? No. Would I sell my bonds if equity markets tanked? Yes, because that's what I've got them for in my portfolio. It's as a hedge for equity. But I'd be quite happy to hold my bonds forever. I'm not going to sell them until there's an equity market event, a big sell-off, and then I'll probably sell them to buy equity. Or if I run out of cash to buy equity, I'll sell some of my bonds. But I won't sell them before then because, I've got them forever. Just look at what happened in January. We had a big sell-off in treasuries. They fell. My portfolio of treasuries, my long duration treasuries in the UK, my long-term gilts fell by about 12% at one point, but I didn't sell, and then they recovered. And they carry on generating income forever, regardless of what happens to price. So, I'm happy to hold on to them and just use them when they're needed. So no, I'm not selling. A. James says, "Hi Ramin, with your extensive knowledge of options, why don't you use option strategies, risking a small percentage of your money to enhance your gains?" Well, the thing is, I quite would like to do that, but brokers in the UK, it's difficult to buy an option. You can do it with IG, for example, but it's actually structured as a spread bet, which I don't like, or a CFD, which I just don't like the idea of. I don't like the whole CFD thing. So, if you could just buy options, I might be up for that. There are lots of fun strategies which you could use and which I'd love to use, particularly yield enhancement. But again, in the UK, not only can we not buy options easily, we can't buy yield enhanced funds like QYLD, where you can monetize the volatility of NASDAQ. You can make 12% dividend on the NASDAQ, which is incredible. But can you buy it in the UK? No. So it's just crazy the choice we have here. But that's why I don't usually buy the options, because it's tricky to do it in the UK. And the other thing about options is you have to monitor them, and I'm quite lazy and quite busy, so that's why I think just buying a global equity fund is kind of more my thing, because you don't have to monitor it, you don't have to think about it. I've got my fund portfolio. Maybe I'd do some options trading in that, but for my core, I certainly wouldn't. I hope that answers your question. So how are we doing for time? We've got 15 minutes. And so let's see what we've got. Yeah, do share. That would help us. And remember, you can always subscribe to our channel, and that way you won't miss our content. AR says, what happens to your stocks and shares if your broker, such as II or Trading 212, goes bust? Well, remember, you still own the stuff. So there's very strict rules from the FCA, the Financial Conduct Authority, with keeping client money separate from firm money, as they call it. So Trading 212 and their cash account at their bank will be completely separate from the money that you hold. And also the assets that you own will be kept by a third party. So, something like Winterflood Securities is the one that most UK firms use. So that's why I think it's fairly unlikely that you'd lose money, even if one of these platforms went down. And it's notable that no platforms have gone down, because in order for that to happen, they'd have to be deeply unprofitable. And it is fundamentally a low risk and high cash generating business, being a broker. Just look at the accounts of some of the brokers out there. Even the ones which offer a free account, usually they're making pretty good money. Free trade is making, I believe it's making a profit, but it's certainly able to raise money very easily. And the reason for that is people realize, I think, that it's a low risk business which is very cash generative. So I really wouldn't worry about platforms going down. A much bigger risk is your behavior than platform risk, I'd say. So A. Smith says, if you can choose, what's better? To have government bonds ETF in your ISA and stocks in a normal taxable account? Oh, interesting. Or the other way around. So I guess, so in a normal account, I mean, the problem with a non-ISA account is that obviously you're liable to tax, capital gains tax, for example, but also income tax. So what many people do is they put so when they're coming up to retirement, they put the government bonds in an ISA and they sell that first because it doesn't require any payment of capital gains tax or income tax when they sell the bonds. And then the rest of the stuff they could have outside the ISA, and then they'd sell that afterwards. Or you put the long-term stuff into a SIP, and then you sell the equity, which is in the SIP last. That's what many people do. But for the general investment account, remember, you're going to crystallize a gain if you sell with a profit. So anything which will crystallize a large gain, you'd probably want to put into the tax sheltered structure, which would be the ISA. And anything which you probably wouldn't get a gain on, in fact, anything which you have a loss on, you can actually write off against future tax years. So in the case of a general investment account, I'd probably say put the equity into, I guess I'd put it into the ISA if I thought it was going to make a big gain. And if I thought there was a risk of loss, if it's more volatile, maybe I'd put it into a general investment account. Maybe that's the way I'd approach it. And if you're going for income, then I guess it depends on how close you are to your income limit. But maybe you'd keep your bonds outside the ISA if you're before retirement. But really depends on your circumstances and how close you are to that income limit and capital gain limit, and whether you think you're about to make a loss, which you need to write off against future years. So I don't think there's a really clear-cut answer for that, actually. Interesting question, though. Right. Midnight Sun says, hi all, I'm an investor as of a week ago, thanks to the channel. That's brilliant. That's good that you've finally taken the plunge, Midnight Sun. That's very good. I hope it's gone okay. Hedge Fund says, hi Ramin, hi. Ganox says hello. And Multiform says, congrats on the award, Ramin. Thank you very much. So in case you're not aware, in case you weren't with us at the beginning of the video, I can actually take it out of the box now. There we go. So this is our YouTube award. So we've just unboxed it live on YouTube. Very exciting. It was too. Let's see what else we've got in terms of questions. Oh, interesting. Yeah. For China stocks, e.g. Alibaba, do you see any benefit reduced risk to invest via the Hong Kong entity 9988 as opposed to the US ADR, BABA? Well, yes. I think what's least likely to happen is that the Hong Kong entity will cease trading. What's actually much more likely is that the US ADR, the American Depository Receipt, will no longer be linked to the company in China, because if you're not aware, then these things are linked together. The ADRs, which trade on the US stock exchanges, and the parent company to which the price is linked, they're linked by something called a variable interest entity, a VIE. Now that's never been tested in a Chinese court, and it would be subject to Chinese law. So if the Chinese suddenly turn around and say these are no longer legal, well, in theory, the ADR's value could go to zero. They'd be stupid to do it because it would effectively starve them of all capital on US markets, on US exchanges, which would be a ridiculous thing to do. But, they've been doing some pretty ridiculous things recently. But I think that would even go beyond what they've been doing during their recent policy changes. So I'd say the lower risk one would be the Hong Kong entity, because that link is much less likely to be broken. So that's probably the better way to get exposure. And that's one worry I've got about KWeb, which is that it gets its exposure to all those Chinese stocks via these ADRs, many of them, and those could not work at some point in the future at the whim of the Communist Party in China. So that is a worry. Yeah. Cole, thoughts on the semiconductor industry, especially with the fragmentation of manufacturing due to geopolitics? Will this inefficient market dynamic ever come back and bite the industry bad? Well, what's pretty clear is China wants to dominate that space of semiconductors. At the same time, the US is going to depend less by choice on China and do more of the manufacturing domestically, because they've seen that this is a threat to US security in a way, because it's so dependent on silicon chips for everything from cars. Even your toaster probably has a silicon chip in it nowadays. Your phones do. Almost every aspect of our lives has some degree of has some semiconductors in it. So I think that's why the fragmentation is already underway. It's not necessarily a bad thing, because it does mean for people like us in the UK, we'll have more choice. We all have the choice of buying it from the US or from China, although we'll probably end up buying it from the US for reasons of national security, I suspect, later on, if this kind of rift between China and the US really starts to widen further. But in terms of how it's going to affect prices and companies which manufacture chips, I don't think it's necessarily a bad thing. Remember, a lot of the US companies have the technology to do this domestically anyway. So it's not a case of reinventing the wheel from their point of view. They know how to do it. It's just cheaper to manufacture it in China for them in many cases. So is it a problem? No, I don't think so. Is this going to happen? Yes, I think the supply chains will separate. And I think there will be a big competition between the US and China in supplying that tech for the rest of the world. But I guess as an investor, you could invest in both. That's the way to look at it. It gives us more opportunities rather than less, as long as you're comfortable investing in China, which obviously isn't as safe as investing in the US. So, I'm not that concerned about it. Akash Deep Singh says, just one question. Is Jack Ma completely out of Alibaba? Because I checked 20F 2021 and he was not in the main shareholders section. That's new. I didn't know that. I'm sure that would have been in the newspapers if he was no longer a major owner of the company. So, yeah, I don't think he's completely out of Alibaba. I'd certainly have to double check that, but I'm sure that would have been in the headlines if it was true. So I think that might just be misleading. I don't know, the 20F form that you looked at, but I'd be surprised if that was true. Johnny123 says, is there a place which shows the percentage of GDP which makes up inflation? E.g., how much does petrol or gasoline add to inflation as a percentage of all GDP? Well, GDP is one thing, and then growth, and then inflation is another. So what you could do is look up how much. Well, certainly, if you look at the CPI index. So let me just share my screen. This is what we were looking at earlier. Tell me if this is obvious to you, but let me just share this with you. So this is the Consumer Price Index that's published by the Bureau for Labour Statistics, and they do the breakdown. So they'll show you what percentage the increase in energy is, how much the percentage in food is, and for example, you can see medical care commodities went down, so you've actually got deflation in that index, that subcomponent. So you can break it down. And what they also give you are the weightings. So if you go to the detailed breakdown of the release, they have a whole bunch of tables which tell you the weightings of each of these different categories. So you could reproduce it. It would be very difficult to do because there are thousands of components, but it's certainly theoretically possible to do that. And if you look at the news release charts here at the bottom, one of the graphs which they give you is a drill down into the components. So all items is up by 4%, energy is up by 25%, and if we click on that, you can see that energy services and commodities are very different. So commodities have gone up by 42%, services only by 8.5%. So you can drill down. So fuel oil and gasoline both up a lot, and then you can drill down into the release, and they've got a nice little graph on the Bureau for Labour Statistics website, so you can do that too. So I hope that answers your question.
He just gave us a donation.
Oh, right. Thank you very much. Someone just super chatted us. James Hendry. Thank you very much for your super chat. That's great. Thank you very much. And does he have a question?
Not that I can see.
Very good. Thank you very much. We appreciate it. And we have 3 minutes to go. So let's look for another question. And let's see what we've got. I'll scoot down to the bottom. Okay. Taz D says, China wants to dominate everything in the world. I'm good with the basic 90s era toaster from the thrift shop. Very good. Gets the same job done in the same time. Very true. Or a fire. Why not even go lower tech than a toaster? And Bob says, I see Bailey Gifford are holding both ADRs as well as HK entities, but mostly ADRs. Yeah, I mean, that would worry me, I think. But you're right, they do split it. And I've seen other fund managers do that. Some are HK entities, some are ADRs. So that is interesting. Okay, so Surab Sunil says, hi from India. I see the Nifty Index price to earnings ratio at 38, well above the historic 25. I think people are pricing in most optimal scenario. What sense can I make of the seemingly overvalued markets? Well, I don't think you can. The problem is that markets can stay overvalued for a very long time, and selling just because markets are overvalued is not usually a good idea, because it doesn't tell you anything about timing. All it really tells you is that over a decade, usually, the returns are lower than they would be if valuations were lower. But over a 2-year period, it has almost no bearing on what the return is. It only has a bearing on return over longer periods of time. So I really wouldn't worry too much about valuations being high, or even change your investment strategy too much. But just be aware that that's usually the case. When valuations are very high, price to earnings, then over the next decade, usually, returns are usually lower than they would be otherwise. But that also tells you if you're a young person and you see markets crash, you should go all in. Get every spare penny and plow it into the equity market, because that'll probably make a big difference to you over the long term. But if valuations are high now, there's not much you can do about it. Maybe take a bit less risk, but as I say, it doesn't tell you if equity markets are about to tank, and you could miss out on more upside. Jonathan Ward just gave us a £5 super chat. Thank you, Jonathan. And he says, do you think that Bitcoin has a prominent place in the financial future of the world? Yeah, I think it's probably going to be around, as long as people believe in it. I think, if you watch if you read the books by Neil Gaiman called American Gods, it's interesting because the gods actually get strength when people believe in them. And I think cryptocurrency is very similar. If people stop believing in Thor, he gets weaker. And I think if people stop believing in the narrative behind Bitcoin, given that there's no fundamental value of the thing, it doesn't generate cash flows or any value, intrinsic value, then it gives it strength. But if people stop believing, then it has nothing to fall back on. Whereas with equity, if it does generate profits, a company, even if nobody believes in it, there'll still be people who'd be out there buying it because it's going to generate a profit in the future and generate dividends and cash flows. So I really think it depends on how good people are at generating a narrative behind Bitcoin. And of course, the risk is always that Bitcoin falls out of favor and other cryptocurrencies become more acceptable. So that's always possible. But certainly for the near future, yeah, I think Bitcoin's going to be around for a while. Obviously, there are legislative issues because people could clamp down on it. We saw in China what happened is that they clamped down on it, the government, because they saw it as a threat, and they're worried about capital flight probably. And that could happen anywhere. So yeah, I think it'll be around for a while. But certainly, compared to standard investments like shares and bonds, I think it's definitely out there, right? It's much more risky, and I think the risk of losing a lot of your capital is much higher than it would be for a conventional investment. And that's why I'd never put the core of my portfolio into cryptocurrency, because I just think it has that risk that comes with it, an existential risk, which just isn't there for equity. Anyway, we're over time, and thank you all for joining us, and great questions as always. Remember, we've got the YouTube live, an unusual one, only a week away on Thursday, same time, 7 o'clock, with Robin Wigglesworth, who'll be talking about his book Trillions. So I have some brilliant questions ready for Robin, and I'm sure he'll enjoy the session. And do go out and buy the book. I really enjoyed it. And thank you for joining us. And remember that you can always support us by clicking on the join button underneath this video, and that way you kind of support us directly on YouTube, and we'll answer your questions first on these YouTube lives. So have a great week, and we'll see you next Thursday at 7 p.m. with Robin and Ramin. Bye everyone.